The Federal Reserve's December interest rate cut has renewed attention on the U.S. housing market, especially for buyers facing high mortgage costs after years of elevated rates. The Fed lowered its benchmark rate by a quarter percentage point, marking its third cut of the year and bringing borrowing costs to their lowest level in nearly 3 years. While the move was widely expected, it has raised questions about whether mortgage payments will meaningfully decline and whether housing affordability can finally improve. Following the rate cut, average 30-year fixed mortgage rates have settled into the mid-6% range, lower than earlier in 2025, but still far above pandemic-era lows. At these levels, a $600,000 mortgage now carries a monthly principal and interest payment of roughly $3,600. That represents a noticeable drop from earlier this year, when similar loans often exceeded $4,000 per month, offering some relief for buyers at the margins. However, analysts caution that mortgage rates do not move in lockstep with Federal Reserve decisions, since long-term rates are more heavily influenced by Treasury yields and bond market expectations. Federal Reserve Chair Jerome Powell has been clear that rate cuts alone are unlikely to revive the housing market. Speaking after the decision, Powell said the reductions would not make much of a difference for a sector still constrained by limited housing supply and elevated home prices. Many homeowners remain locked into ultra-low mortgage rates secured during the pandemic, reducing resale inventory and keeping prices high despite softer demand. These structural challenges continue to limit affordability even as borrowing costs ease slightly. Markets responded positively to the Fed's move, with stocks rising and real estate-related shares gaining on expectations of improved financing conditions. Mortgage lenders may see increased activity as buyers who have been waiting on the sidelines re-enter the market, but economists warn that a full housing recovery will likely require more than modest rate relief. Without significant increases in supply or price adjustments, affordability pressures are expected to persist into 2026. In the end, the Fed's December rate cut offers incremental relief rather than a turning point. Monthly payments on large mortgages have come down, but the broader housing crisis remains unresolved. As Powell and other policymakers have emphasized, interest rate cuts can help at the edges, but they cannot, by themselves, fix the deep-rooted challenges shaping the U.S. housing market today.